Tim, what is NEMA's outlook on the economic forecast?
Well, Kathy, NEMA's outlook is that the economy is certainly firming and has been for the last 6 months or so, notwithstanding the admittedly disappointing report on GDP growth that we had in the first quarter. That was likely due to some hopefully transitory factors. As Ken suggested, the labor market is beginning to turn the corner, and indeed we're seeing an accelerating pace of job growth over the first several months of the year. That's an important sign going forward, suggesting that businesses are beginning to develop the confidence in the economy to make long-term investments in people again. But at the same time, we expect that it's going to continue to be a long and probably fragile haul for the economy. We are in expansion phase. We think the expansion will probably look a lot like the recovery, slow and somewhat unsteady growth as we continue to try to surmount the obstacles that have been put in place in the aftermath of a very serious financial crisis. Let me turn, though, to the electrical industry itself. What you see here are the results over time of a survey that NEMA conducts of its many of its senior member company executives, the Electric Industry Business Confidence Survey. I'm sure many of, or at least some of the panelists are probably sitting here in the room, and thank you for your participation in this, and we hope you'll continue. What we have seen regarding current conditions, which is the black line on the chart, in which values above 50 indicate improving conditions, and values below 50, the red line, vice versa, declining conditions. What we've seen since late 2009 are generally improving conditions as reported by NEMA executives. There have been a handful of bumps in the road along the way. Most recently, we've seen a bit of a pullback over the last couple months, thanks in large part to developments in both Japan and in the Middle East. But nonetheless, fairly steady values above 50, suggesting that the industry is seeing some, a fair amount of improvement. The future conditions index, which looks out 6 months, asking executives to compare what they expect to see a half a year down the road to the current month, is looking quite strong. That's the blue line, and that's up near levels that it was last at during the heady days of 2003, 2004, during the midst of the last economic expansion. A very large proportion, around 80% or so in our most recent data, of executives expect that conditions are going to continue to improve over the next 6 months, at least to some degree. Taking a look at some data on the actual dollar value of shipments of electrical equipment, tells a similar story. The green bars here are the historical performance going back several years. The red bars are our expectations going forward through the end of 2012. And what you can see is that coming off the low point in late 2009 through the first quarter of 2011, we've recouped about half of the value of shipments that was lost during the recession. Our hope and our expectation is that should the larger economy continue to improve, even at the historically slow pace that we expect, that by the end of 2012 we should be about back to where we were in terms of dollar value of shipments on the eve of the downturn. Unfortunately, though, it's been something of a two-speed recovery that we've seen for the electro industry. The manufacturing end markets have done much better than the construction end markets, as you might expect. And by manufacturing, I'm talking about motors and industrial controls and products of that sort that automate production processes. In the manufacturing sector, that's been an area that's really helped lead the economy as a whole out of recession. On the construction side, it's not been nearly so strong. What you're taking a look at now is NEMA's Lighting Systems Index, which is a compilation of data that we collect in our market statistics programs in areas like lamps, fixtures, ballasts, and emergency lighting. Now, certainly within this aggregate, there have been some areas that have done well, but in general, lighting has really struggled to gain any momentum since bottoming out in 2009. And a similar story as well, it can be seen with our Building Equipment Index, which is culled from data on low voltage distribution equipment, conduit, outlets, switch boxes, and the like. There's been a little more upward movement here over the course of 2010, but nothing to the degree that we've seen on the manufacturing side.
Tim, question for you. We've seen over the last several months commodity prices, oil, metals, and other kind of commodities, they've climbed sharply as the recovery's taken hold. One of the questions that I would have is, what's driving the commodity markets at this point? And how big a drag do you think that this price escalation is going to impact on the recovery?
Well, Kathy, I think the story with commodity markets is fundamentally a demand story. We have had generally increasing economic growth with obviously a large pause during the recession, but over the last decade, if you look at what's been going on, the U.S. economy is no longer the world's sole growth engine. We've had the emergence of China and India, just to name two in particular, and they are very, very large consumers of commodities and raw materials of all kinds. I think one telling statistic is relative to China and the copper market. 10 years ago, back in 2000, China accounted for about 12% of global copper consumption. As of 2010, that figure was up to 37% of a much, much larger pie. Over the same period of time, North American consumption has gone from about a quarter to about a tenth of global supply. So there's been a major reordering of demand forces in commodity markets. Added onto that, of course, you have the fact that these are now and have been for some time traded on exchanges, and all of the factors relative to demand and price that play into that are at work as well. If you're looking for some sense of the direction of prices of some of the commodities over the short term, one valuable and useful place to look can be data from futures markets. That's one real positive of having exchange-traded commodities. And if you take a look, for instance, at the futures curve for crude oil right now, as well as for copper, it looks that it tends to reinforce a lot of the opinions of metals and oil market analysts out there that suggest that current prices may have gotten a bit ahead of fundamentals. These are essentially flat futures curves out over the next 12 to 18 months or so, suggesting that we may see, if not some pullback, at least some flattening off in some of these prices. Now, is this a perfect predictor? Absolutely not. But these are players in the market with a lot of money at work, and the prices reflect their decisions. And I suspect that they're probably just as good as any other commodity price forecast out there.
Thank you very much.